Growing your business can mean big-time logistical questions like, how are we going to keep up with all these local deliveries? Let Uber Direct offer you a helping hand. With Uber Direct, you take orders on your website, app, or by phone. Then drivers who are part of Uber's courier network pick them up from your store and deliver them to your customer's doorstep. Sounds simple, right? Delivery just got better with Uber Direct. Learn more at uberdirect.com. This has been a weird year in the restaurant industry, and what are we to make of it? Hello, this is Jonathan Mays, Editor-in-Chief of Restaurant Business, and in this week's episode of A Deeper Dive, I speak with Kenny Kraft, a Managing Director with the investment banking firm Houlihan Lokey, and Tyler Martinez, a Vice President. This year has definitely been an odd one from a sales perspective. Consumers are cutting back on fast food chains and casual dining concepts, but appear to be spending more at restaurants overall. Some companies are filing for bankruptcy, and others are generating record high sales. Many concepts are grabbing share from their direct competitors like Chili's, Popeyes, and Domino's. We talk about what's driving these share gains and these sales differences. We talk extensively about consumers' perception of value and how brands can get on the right side of consumer perception of quality. Hint, it will take a while. We also talk a bit about the entertainment sector and what is driving sales challenges in that business this year. We're talking about the state of the restaurant industry on A Deeper Dive, so please check it out. All right, I'm here with Tyler Martinez and Kenny Kraft. Tyler and Kenny, welcome to the podcast.
Thanks for having us.
All right, so Tyler, why don't we just start with you a little bit? Tell us a little bit about yourself.
Yeah, sure. I'm a vice president here at Houlihan Lokey, based in our Los Angeles office. I spend most of my time in what we call out-of-home entertainment. There's a really broad category in terms of what you spend money on outside the home for fun. Some examples could be a family entertainment center, could be an entertainment concept, and of course, restaurants as well.
All right. Kenny, what about you?
Absolutely. Well, Jonathan, thanks for having us both. And I'm Kenny Kraft. I'm a managing director here at Houlihan Lokey, where I am responsible for what we call our multi-unit practice. And specifically, I cover retail businesses in the food and automotive ecosystem. So restaurants is my primary area of focus. I also work with convenience stores, car washes, businesses like that. And what I'd say is I've spent nearly 2 decades of my career advising companies in those ecosystems, going back to when I first came out of college. 2 of my first clients I worked with, one was in the automotive space and the other one was a large prominent QSR brand. Have been working with restaurant operators ever since. I actually recently joined Houlihan Lokey, having worked prior to Houlihan at JP Morgan, where I was responsible for covering mid-market companies in the same sectors. And so here at Houlihan, what we're responsible for is primarily mergers and acquisitions, as well as capital raising in the restaurant and out-of-home entertainment space.
All right, super. Let's start off with this question. This has been a weird year. Not going to lie. It's actually a little bit backwards almost. As we speak, this morning, retail sales data came out showing restaurant sales actually so far this year relatively healthy, both on a no matter really how you kind of look at it. Restaurant sales have been outpacing the broader economy. You still have a lot of operators continue to build new locations. Job numbers in the restaurant business have been growing at a relatively healthy clips, almost 70,000 jobs last month. And yet it's coming during a year in which we have had a large number of bankruptcies filed over a very short period of time. We have significant concerns about the low-income consumer cutting back on fast food restaurants. They're not cutting back on all restaurants, by the way. They're cutting back on fast food restaurants and casual dining. So usually in a scenario in which consumers are sort of cutting back, fast food restaurants usually gain in an environment like this. They are not gaining in an environment like this. What do you make of this? Kenny, you were nodding your head. What do you think about that?
Jonathan, that's a great opening question, and one that's very top of mind for us as advisors to the sector. And I would even be as bold as to say not only has 24 been a weird year, but really the last 4 or 5 years have had no shortage of interesting times in this space, certainly. And we are mindful of all of the various operating challenges and headaches that restaurant owners and operators have been dealing with in the current environment. And if you go back even, a few years earlier, of course, first it was the pandemic, and then it's become the interest rate environment, food inflation, labor costs, labor shortages, industry turnover, and most importantly, as you just mentioned, what is a very beleaguered consumer right now. And so, we're taking a very watchful eye on consumer spending, consumer sentiment, consumer trends as it relates to restaurant performance this year. And kind of our current outlook or current viewpoint is, if you look at the trends, particularly through Q2 of this year, obviously we've got an upcoming earnings cycle in Q3. It would be very interesting to see how the public restaurant operators report. But clearly wages have not kept up with broader inflation, and there's been a significant amount of price sensitivity, particularly among lower income and middle class consumers, as you mentioned. And while we're starting to see a more positive macro outlook as of late, what you've seen this year is you've seen the impact of what that kind of beleaguered consumer sentiment can do to restaurant operators with some of the traffic trends that we've seen this year. So it's definitely been a bifurcated market of winners and losers. And I think one of the key things that we've noticed is the operators who have a differentiated value proposition, those are the ones that are growing, maintaining, holding traffic, depending upon the category, at various levels. And, one of the things that Tyler and I spend a lot of time talking to our clients about is what is that value proposition? And that value proposition can vary across the category. So, if you look at QSR, historically QSR's value proposition has most closely correlated with price. But consumers don't just value the lowest cost alternative. They're also looking for speed of service, order accuracy, consistency, quality, and of course, price. So, there's plenty of examples of, recent initiatives QSR operators have done to continue to drive traffic within their locations. Then if you go into fast casual, the categorical definition of value is really around the quality of food, quality of ingredients, having the flexibility and customizable offering to your consumers, offering a pleasant environment in which to dine, and kind of having that affordable luxury at a price where the consumer says, I'm really getting a strong bang for my buck. And then lastly, you talked a little bit about, casual dining and kind of how to define value within casual dining right now. And to me and to us, it's really about the experience, the atmosphere, and kind of the consistency of offering that has a consumer wanting to come back. Arguably, casual dining and full service has been, kind of full service more broadly defined, has been the area where we've seen the biggest traffic pushback this year. So it's really important to execute the small things well and give your customer a feeling of perceived value relative to the expenditure, if that makes sense. So I know I kind of said a lot there, and there's probably a lot of different directions where we could go, but maybe I'll pause there for any reactions.
Oh, yeah. I usually have a few reactions, but let's talk for a minute just about the state of the consumer, because like one of the things in your report was noting that your expectation is that wages are going to be outpacing inflation by the end of the year, and that's actually already started to happen. I mean, wages have in the past couple of months have been outpacing inflation. The numbers on retail sales data might actually be kind of suggesting that a large swath of consumers are feeling okay and are more willing to spend these days. I mean, it just takes a while for that sort of thing to filter through and start showing itself in terms of price sensitivity? I mean, could we start seeing fast food restaurants regain some of that traffic?
Yeah, no, certainly. It's funny because once prices hit a certain level, you actually come to a comparison level. And I'll give you a really short anecdote from my father. I visited him back home last weekend. We did this fun little thing in my hometown called Oktoberfest, and we stopped at this pub. And I looked at the menu and I was like, Dad, this burger's $15 now. Last time I was here, it was 9. He's like, yeah, I know. Isn't that great? Because I can get a burger here for 15 bucks or go to McDonald's and get a $14 value menu or Big Mac meal, whatever it might be. So to some extent, yeah, wages helps, more discretionary income. Maybe you'll spend more at places where you typically do. At the same time, prices have hit a level where even if you do have more income, you still see value elsewhere. So where QSR gets its value prop back, in my opinion, are these value menus, are these not necessarily promotions in terms of discounting, but adding a lot more value for or bang for your buck, is a concise way to say it.
Yeah. I think that's kind of that bang for your buck has really gone to the forefront. Let's chat for a minute about one comparison, because you brought up McDonald's. You brought up that comparison of how much you're gonna spend on a burger from one place to the other. And one of the if you adjust for performance of the overall sector, the best performing restaurant chain last quarter was Chili's. Chili's did 14.8%. By the way, I've been covering this business for almost 20 years. And I have data going back pretty much that far. Chili's has never done 14.8. They've been coming close. I mean, except during the pandemic, but 2021 does not count because, sales fell to nothing in 2020. So Chili's does 14.8%. That was some, 15, it was, 15 plus percentage points higher than Applebee's. Chili's should never do 15 plus percentage points higher than Applebee's, or vice versa, whatever. That those two chains are, in the consumer's mind, there's not a whole lot different, on balance between those two concepts. And so, and they did this, as you guys know, by offering, this 3 for me proposal, this 3 for me offer, and take advantage of a social media, social media trends that were starting to point out the value of what you get for your money at Chili's, which means that Chili's has been able to, and Chili's took full advantage of this, started comparing themselves to McDonald's. They actually came out with a Big Smasher burger that was largely a Big Mac rival. On balance, and I did the price comparison, Chili's is still more expensive, than McDonald's generally. I mean, you can get a lot cheaper items at McDonald's, but to the consumer's eye, what they're getting at Chili's was far more. They're getting more at Chili's than they would at McDonald's, and Chili's essentially won the war. I mean, is this what we're just going to see from now on? Is where consumers aren't so focused just on the dollars that you're spending, but how much they get for it?
That's a really good example, Jonathan. I think one of the best in the space. And look, price is important as you talk about bundling, LTOs, et cetera. But what I think really stands out about the Chili story, and there's other examples as well, is leveraging kind of your environment, leveraging your brand, leveraging digital, and doing so in a way that emphasizes some of those classic flagship menu items. And it kind of draws the consumer in with, there's a brand recognition, there's a menu, affinity for certain items. And when priced appropriately, or when giving the consumer that perception of value, can really drive outsized benefit. And so you certainly saw that with Chili's comp that they had posted, and the outsized performance there. And they don't necessarily stand alone in that regard. Whether it's QSR, fast casual, or casual dining, we have seen kind of exemplars rise to the top in various categories. And I think one of the things that's consistent across those categories is that perception of outsized quality for the expenditure.
So how do you overcome that? Like if I'm an operator, I'm an operator and I really want, and how do you get that reputation for quality? It's not something you can just turn on. The perfect example that I give is Subway. Subway this year has had some very persistent sales challenges. And, back in the day, many years ago, they did have a quality perception in the market. They have a price perception in the market. They have been trying to, communicate to the consumer with their advertising that they have higher quality subs. The consumer, I don't think necessarily gives them any credit for that. You tend to get a lot for whatever you're spending at Subway. But the consumer continues to remember the $5 footlong. But you can think of any number of restaurant chains that just haven't been able to, for whatever reason, the consumer just doesn't give them any credit for quality. How do you do that?
Yeah, and I'm glad to jump in here, Tyler. From my perspective, it's it's a long road to build trust with your consumer. If there is a misperception of quality, and it can be easy to lose the trust with operational missteps or hiccups. It really kind of gets back to execution of the core kind of flagship food service offerings and delivering that consistency of experience among your system for your customers. And obviously for company operated locations, you have more control over the operations, that can be executed upon, by the corporate parent. For franchise locations, it's about having good relationships with your franchisees, executing consistency of message, ensuring consistency of performance across the system. But I think it's that consistency that really drives the consumer's trust and the consumer's loyalty. And if it evaporates, it can take time to build it back up.
The differentiator between these concepts. So take Wendy's, for example, fresh, never frozen, immediately comes to my mind. I don't know if a Wendy's burger is necessarily higher quality than a McDonald's burger. I don't know all the science behind it. But in my head, I hear fresh, never frozen. That sounds healthier, I guess. Sounds higher quality. Charbroiled burgers from Burger King gives a realistic aspect to it. You charbroil a burger at home, so is it homemade? But some conveyance of quality doesn't necessarily have to come out through value or anything like that, but just how it's being marketed to the consumer. I feel like it's important.
Yeah. Well, it seems that there's some pressure on brands to continue to, getting that, the Wendy's example that you bring up was something that they've had from almost the get-go. They've been marketing themselves as fresh, never frozen beef, and they do generally tend to be viewed as the higher, a bit of a step up from their competitors. But the Burger King example, they also like to, they also had, flame grilled Whoppers and stuff like that, and pushed quality for a while. But, really over the past 20 years, they spent too much of their marketing, probably, frankly, pushing value. And, and that might have hurt them from the marketing standpoint. So it seems to me that getting that quality reputation requires a lot of patience. I don't think a lot of operators always have, because you have to continue to hit that message over and over and over again to get the consumer to understand it, while also following through on the operations inside the restaurant and the products that you're putting to your customers. That it takes a lot of time and a lot of patience to be able to build that. In the meantime, you have consumers that aren't necessarily giving you the credit for whatever you're doing all the time. It just seems like it takes a while to get that.
Yeah, and Jonathan, one of the things I would say is it's a confluence of factors that goes, obviously the quality of ingredients and the quality of the food product is of course of paramount importance to having that consumer trust. But there's so many other factors in addition, and that are of equal importance. Whether it's order accuracy, it's the perception of this is what I wanted and it's what I got. That is so important, and that's across QSR, fast casual, and casual dining. That plays out in many ways. And one of the things that I think has become increasingly interesting is we're starting to see some technological innovations, both in the kitchen as well as consumer facing, that help improve order accuracy, speed, food quality, and frankly, on the back end, like margin enhancing initiatives like food waste and shrinkage and things like that. So it's not just the quality of the ingredient and the food quality, but it's also in how it's prepared, delivered, packaged, and ultimately the experience that the consumer gets.
Mm-hmm. Yeah. One of the interesting things about the current market, and we talked about Chili's versus Applebee's, and this is something that you actually noted. We see a lot of brands grabbing share right now, and I mean, you guys have been around a while. You know that usually if one again the Chili's Applebee's scenario, they usually follow. You don't see that kind of gap between those two brands all that often. And they usually follow the same sort of cadence on balance, so, it's usually just a couple of percentage points of difference. But we've seen a lot of brands actually grab share currently in the pizza market this year. Domino's has been grabbing share in the pizza sector, for instance. In the coffee sector, we've seen Dutch Bros grab share from Starbucks. Again, the Chili's, Applebee's example. We've seen a lot of situations. And so it seems like the consumers, at least in 2024, is getting really picky or choosy about what brands they go to and for whatever reason. And maybe it's that Chili's just happens to have a really good deal and people are following it on social media, or just for whatever reason, their marketing or their other strategies are working. Tyler, you got any thoughts on that?
Yeah, it's funny, and the one that actually immediately came to mind is the KFC Popeyes comparison.
Oh yeah.
So I've got a former coworker and a buddy who owns a few KFCs, and he's racking his head over it. He goes, "My chicken is better. I like it more. I'm saying that unbiasedly." So why did Popeyes take so much more share from KFC? And it comes down to marketing, the exposure of, hey, like KFC did X, Y, and Z. They may have a lower value because their chicken had a crisis a few years ago. People just perceive it as lower value because of things that happened a decade ago. And so why did Popeyes pop off today? They blasted marketing. They're really good on digital. They're really good at grabbing people within my generation who grew up and went through KFC as, oh, you don't want to go there. You want to go to a different sort of chicken food operation. But yeah, it's tough. It's been very difficult. And sometimes it comes down to getting in front of the consumer and conveying value. And sometimes it's just other options.
Yeah. Yeah. It seems like value or quality is something that you have to kind of just hit on a very consistent basis. Just continuing to remind your consumers that you are the better option. I mean, your KFC Popeyes is actually a perfect example. And I think the difference was somewhere like 1,100 basis points or something like that. It was a little ridiculous.
That's right.
And again, I mean, one of the most remarkable things I've seen actually is seeing Popeyes overtake KFC in terms of total sales in the United States, which is, especially given KFC outside the U.S., is insane. It is, for all intents and purposes, KFC probably should be the second biggest restaurant chain in the world, and they are not. And if not the first, and that's a little ridiculous. You guys are a little bit familiar with the entertainment sector. Yeah, I want to take a couple of minutes before we go about that, because what's happened there is also fascinating, and I'm trying to figure out why. Because coming out of the pandemic, we had all these people unleashing this pent up demand and just flocking to entertainment concepts. So Topgolf was killing it. Chuck E. Cheese, all these brands started getting all this investment. And now we see some evidence that consumers are kind of pulling back. Topgolf is being spun off at Topgolf Callaway. We've seen some other challenges in the market. What's going on there?
Yeah, certainly you got some of that pop 21, 22, and to some extent the beginning of 23. that a lot of the entertainment concepts benefited from. I think when you're moving into 24, it's not necessarily value, it's understanding what these concepts are. For example, is an entertainment concept a restaurant, or is it somewhere you go to play golf in the case of Topgolf? I don't think food comes to mind first when you think of a Topgolf. When you think of Pinstripes, you have the exact same or exact opposite thinking. I go to Pinstripes because I want food, and also I can play some games while I'm there. So some of it is conveying again to the consumer, hey, come here for entertainment. Hey, come here because we got really great food. In terms of pricing, all of them took price for the most part. So I really don't think it's as though that's too expensive because you can play with the menu. You can introduce lower cost options, shareables, etc. But really where I think entertainment is running to an issue is, what are you exactly? Why should people come here? How do you get the consumer to come to not just once a year or twice a year, but once a month? I don't think that has necessarily been answered or addressed by those concepts quite yet.
Right. Super. Okay, gentlemen, this was fantastic. I really appreciate you joining me this week on the podcast. Really loved it.
Absolutely.
And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Spoons. Artwork by Nico Hines. You may find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com/article/deeper-dive. And you may subscribe on Apple Podcasts or Spotify, or check us out on YouTube. I'm Jonathan Mays, your host, podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening. Growing your business can mean big-time logistical questions like, how are we going to keep up with all these local deliveries? Let Uber Direct offer you a helping hand. With Uber Direct, you take orders on your website, app, or by phone. Then drivers who are part of Uber's courier network pick them up from your store and deliver them to your customer's doorstep. Sounds simple, right? Delivery just got better with Uber Direct. Learn more at uberdirect.com.